I think there has to be an element of flexibility. And I think coming out of the recent rate environment, everyone's so focused on getting the best rate. And sometimes they overlook those flexible features, which in my opinion are very important, especially for investors. Like you said, investors are always looking to unlock more equity, balance their cash flow and all these things. So flexibility is really important.
Hi folks, welcome to the second of our interview series. I'm Ming from Volition Properties, where we help you reach better outcomes through real estate. If you're new to the channel, I've been an investor since 2001, and we've helped our clients invest in over $250 million in real estate. Today, we're thrilled to have Hugo Dos Reis back from Vine Group, super successful mortgage brokerage that we do tons of work with. And today, we're going to be diving into one of the classic questions, which is, should I go fixed or should I go variable? But very much within the context of what's happening right now at the time of this recording, which is November, late 2024. And we're going to be talking about a bunch of different reasons why one or the other may not make sense, and go over some stuff that I think is not talked very much about. So I'll hand it over to you, Hugo. Maybe we can start with what should I do? You tell me.
Well, I mean, I guess, there isn't an answer for everyone's situation, but we're at the end of the year. We're in November at the time of this recording. We just had a U.S. election, take place. Trump came out and won that. So we get a lot of questions on, hey, you know what? Given that there's more Bank of Canada decreases in the pipeline this year and next year as well, what should I be doing? And should I just wait for fixed? And so the conversation is always a variable rate, typically a 5-year variable, because that's where you're going to get the best rates, or a fixed rate, specifically a 3-year fixed rate, because you could go with a 5, but the 3-year and the 5-year rates are pretty similar. So it's almost like, why not just take the 3-year so you can negotiate? So those are the two that we're seeing the most of. And I would say that most banks are trying to get everyone to a 3-year fixed rate. I would actually argue that almost everyone I've spoken with, when they've already spoken to their bank and they're coming to chat with us, they were quoted a 3-year fixed rate, almost always. Like, that seems to be where the banks are trying to compete. And I think the reality is, optically, the 3-year fixed rate is currently lower than a variable rate, despite historically variable rates are lower than fixed. Right now, it's the other way around. So when you look on paper where you can still get a fixed rate in the low 4s, in some cases, high 3s we're already seeing, compared to a variable rate, which is for the most part somewhere in the bottom 5% range. On paper, you're like, wow, why would I take a variable rate where I can get a fixed rate? It's almost 1% lower, right? So it's a very easy sale, as a lender, to be like, hey, you should just take a 3-year fixed rate, lock you up. But we're also in the process of seeing rates coming down slowly. We've had a lot of rate discounts, and we'll likely see a few more as the economy slows down and tries to recover. So the question is it worth taking a fixed rate? Is it worth locking in right now for the next 3 years? Not only are you locking in that rate, so whatever, regardless of what happens to the market, you're going to pay that interest for the next 3 years. But more importantly, for me anyways, is you lose the flexibility where if you want to make changes or get out of it, potentially sell their home, if there's a penalty linked to that, the penalty is going to be a lot higher. And as the rates continue to fall, the formula that the banks typically use, this IRD formula or interest rate differential formula, is going to be more in the favor of the bank, which means a larger penalty. So it obviously makes sense from a business perspective why me as a bank would want to solicit a fixed rate. I'm like, hey, meaning this rate's better than a variable, and you're going to be able to ride this out. But I know that the average Canadian breaks their mortgage every 3.5 years. So you're very likely going to want to consider breaking your mortgage if rates drop low enough, or you'll at least be inquiring. So anyways, that's kind of the narrative that we're seeing with the banks, and that's part of the reason why the banks are pushing that. We've been really big fans of variable. In the last 4 to 6 months, it's been kind of more attractive to look at a variable again. And yeah, they're 100%. It's true that you're going to see a bit of a premium right now for variable. You're going to pay about 1% more to get it to a variable rate. My argument is, if you look at the forecast tables from the banks themselves across almost all the lenders, most banks predict rates to be anywhere from 1% to as high as 2% or more lower by the end of next year. So even using the lower end of that rate, which is 1%, if you can get a 1% discount over the next 6 to 12 months and go with a variable rate, you're already better off than the average fixed rate today. and then you have a couple more years to benefit from your rates. So I think right now variable is really attractive. The one thing that we are seeing though is that the lenders are not making those variable discounts as attractive as they used to be. I remember in the past, prime less 1, prime less 1.1, prime less 1.2 was not crazy to get. Those are not as common and very infrequent that we're seeing those. A lot of banks are actually shrinking those discounts and offering very small discounts. In those circumstances, the variable rate is just not as attractive. It's too much of a spread. But if you can get a really good, generous discount, I would say anything more than prime less 60, 70 or higher is a good deal. There are some lenders on the lower end of that scale. And if you can take advantage of that, I would say, look, take a variable. We'll probably see a 0.5% rate drop by the end of this year, if not between December and January. Some economists think we'll see two drops both in December and January. So the next 3 months, we'll see all that. And then reassess where we're at the beginning of next year. If you feel that variable is a bit on the higher risk side for you, you feel you want a bit of a stable monthly payment, consider the variable, wait a couple months, see where things are at by February once we've seen another bit of rate cuts and a little bit more in direction on the market, and then decide if maybe you want to lock in to a fixed rate or just ride out the variable, because I'm feel fairly confident that we will see variable rates below fixed rates, just like they've been in the past by next year. So that's kind of what we're suggesting. Obviously, this advice isn't for everyone. If you're on a fixed income, on a pension, despite the variable, in my opinion, being more attractive, not everyone's willing to take that risk. And sometimes just locking it makes a lot of sense. The other thing that we have put out there is maybe if you're not sure or if a variable rate is new to you, maybe you're a recent homeowner and all you've known is these crazy high rates. So the idea of a variable just doesn't make sense. I know you and I have been doing this for a long time, and I remember rates when they were in the ones. And we've always looked at variable as an attractive option. In the last couple of years, fixed has become more attractive because of that uncertainty with rate increases. So anyone who's got a home in the last 2 years is probably like, what is a variable? Why would I take a variable? You're crazy. I remember my friend had a 6 or 7% or a higher rate and they were on variable and they were freaking out. So I understand that logic. So perhaps take both, split your mortgage down the middle, get a little bit of variable, a little bit of fixed, and kind of diversify, just like you would with investments. So those are some of the strategies. One thing that I should mention that is really important is fixed rates primarily move based on the bond market. So if you were to Google the 5-year Canadian bond yield, that'll give you some direction as to where bonds are moving. And that directly impacts where mortgage rates are, fixed rates specifically. So that bond market is not the same as the Bank of Canada and the market that shifts the prime rate. So just because the Bank of Canada dropped rates by 0.5% doesn't mean that your fixed rate options will now be 0.5% lower. If you actually look at the last, I'm going to go 1 month just because we had a recent rate drop. If you look at the last 1 year of the 5-year bond yield, you'll actually see that it's increased. I think it was as low as 2.87 and it hit as high as 3.1 just around the election time. I think it's currently sitting a little north of 3. So even though we saw a 0.5% rate drop, the bond market actually went up. And the reason for that is generally the information available within the market and what most experts believe is already built into that price. So whatever the price is today is as a result of all the data that we know about the economy, CPI, inflation, GDP, whatever we know is baked into that rate. So any assumptions around rate discounts are already factored in. So when we had a rate drop of 0.5% very recently, there wasn't an impact because it was already kind of assumed that was going to happen. And we actually saw that rate increase because there were some expectations that weren't met, which resulted in an increase. So, just because the Bank of Canada dropped rates, don't expect rates to be dropping by 0.25% every couple months. I think there's a little bit more movement for fixed rates to come down, but I think they're probably getting really close to where they're going to land. So, that's something to consider too if you have to go fixed.
Yeah, you brought up some really good points. I think one of them kind of earlier on when you were talking, the breaking of mortgages, and I think it's a bit of a a lot of people assume that they're going to stay in their mortgage for that 5-year period. The reality is most people have terms which are actually shorter, and I think for our investors, it's even shorter than that, right? Like you had quoted three something,
3.5. I think the data not specific for investors, just across Canada, it's 3.5 years. Canadians are breaking the mortgage.
I guarantee you, like if you took the investor subsection of that, we'd probably be even less than 3.5 years, because investors are always trying to, refinance or pull money out,
Re-amortize
to a different asset. Like a lot more dynamic. So even more reason to stick with variable. And the other one that you mentioned was stability, and I think it's interesting if you're in a interest rate environment which is steady or increasing, like the stability really is, you want something fixed because you could be worse, like the chances are worse, but there's probably 0% predictions right now of interest rates going up. So really, if you're fine with the payments and the variable rate mortgage as it is now, you're only going to get cheaper, right? It's only going to be down.
That's kind of my argument. I still get a lot of clients who say, well, I'm really worried about variable, which makes sense. Again, the last 2 years have been an anomaly. And the argument is, if you think that rates are not going to go up, then this is your worst case payment right here, right? Very likely we'll see a few rate drops. And at that point, you can reassess. And again, like because we're anticipating rate drops imminently, like in December, in January, and so on, it's like, why lock in and be stuck with something for 3 years? Because that's a pretty long time. I mean, look 3 years back to where we're at today. Look how much has happened. Rates, I think, topped up around 7, and now we're seeing rates creeping under 4, on the fixed rate side. So there's a lot that could happen in 3 years. We don't know. So I think having that flexibility is important. And there are some solutions out there where you can get a variable rate and lock in that payment and you won't see it go up even if rates change. So there's things like that. But I always, like the soundbite I always use with clients is, it's not the rate you get, it's how much you pay over your term. So who cares how great your 2% rate was or whatever? If you're now breaking it and paying a penalty to move into something new, to consolidate debt or whatever it is, then that rate is relevant. You end up paying a debt. So I think there has to be an element of flexibility. And I think coming out of the recent rate environment, everyone's so focused on getting the best rate. And sometimes they overlook that those flexible features, which in my opinion are very important, especially for investors. Like you said, investors are always looking to unlock more equity, balance their cash flow and all these things. So flexibility is really important. So yeah, that's, those are the things I'd be looking at right now. Obviously if we revisit this conversation 3 months from now, let's see, I'd like to say that 3 months from now, February, let's say, rates will be at least 50 to 75 points lower on the variable side. And I think that you'll see a lot of fixed rates already under 4%. There'll be a lot more of that available, especially as we move into the spring market when the banks are more competitive.
That's the crystal ball. We have it in recording here. Check out in a couple of months and see how accurate we are. But I also appreciate your time, Hugo.
Thank you so much, Greg.
Appreciate you coming on this call. If you're interested in getting a hold of Hugo, we'll have all his contact information in the show notes. Thanks for joining. Always appreciate it. And we will keep connected. Look out for Hugo again to be on the channel.
Thanks, Mix. Appreciate it. Thanks for your time.